As a corporate executive, there are potentially many different components to your compensation package. We'll take a look at two of the more complex ones, stock options and restricted stock. Let's first consider how leverage impacts decision-making around stock options. Leverage is the percentage change in the option value resulting from a percentage change in the stock price. The leverage of options can lead to dramatic moves in the valuation. For example, let's assume you have a stock option with a grant price of $15 and the current price of the stock is $20. The option will be valued at $5. If the stock price increased from $20 to $22, the option value would increase from $5 to $7. That means a 10% increase in the stock price leads to a 40% increase in the value of the option. If you have a long period of time before you plan to retire and a high tolerance for risk, this type of leverage provides a great opportunity for growing your wealth. But leverage is a two-edged sword. For those nearing retirement, maximizing the upside potential of options is not nearly as important as ensuring that you don't lose too much on the downside. To develop a strategy for exercising options, we need to first distinguish between those that are in the money and ones that are out of the money. Options are out of the money when the option price is higher than the current stock price. Options are in the money when the option price is lower than the current stock price. Our stock option value preservation strategy will increase the odds of realizing value while your options are in the money. We do this by identifying option tranches that meet at least one of two criteria. First are in-the-money options within 2 years of expiration. Second are those whose price is at least 20% below the current stock price. The main objective of this strategy is to take risk off the table by exercising those options with the most intrinsic value, as well as the ones approaching an expiration date. You can see the net results of this strategy by first considering how the total current value of your options are affected with changes in the stock price and comparing that to our value protection strategy. Obviously, the downside is protected if the stock price falls, but note, there is still some appreciation potential if the stock does well. Lastly, we need to consider how the tax liability works for the most common type, which are non-qualified stock options. Let's assume that in March 2014 you were granted a certain number of options with a grant price of $20 a share. There is no tax when granted. If the stock price appreciated from $20 to $50 over the next couple years and you decide to exercise the options in June of 2016, you would owe ordinary income tax on the $30 difference between the grant price and the fair market value. Then, any future appreciation from the time of exercise to the time of sale of the underlying stock is taxed as capital gains. We often recommend selling the stock immediately after exercising the options. This is called a cashless exercise because it provides cash flow to fund the tax liability while also helping to immediately diversify and protect against the downside. Restricted stock units, or RSUs, have become more popular over the past several years. Unlike stock options, which are taxed when you exercise them, RSUs are taxed at the time they are vested. Being taxed at the time of vesting creates uncertainty in terms of their future value and tax rates on those vesting dates. RSUs are an important way to create wealth. RSU awards can be settled in stock or cash. RSUs often pay dividend equivalents. Make sure you know the terms of the award. Specifically, understand what happens if you lose your employment, retire, or take a position with a new company prior to vesting. Restricted stock awards are similar to RSUs in that you receive a share of stock at vesting. RSAs allow you an opportunity to avoid this tax uncertainty by making what is known as an 83B election. The 83B election allows you to pay the tax immediately, based on the value of the shares at the time they are awarded rather than wait for them to be vested. 83B elections are advantageous in allowing you to set the cost basis up front and pay long-term capital gains tax rates on future appreciation, as opposed to being subject to ordinary income tax rates. It also removes most of the uncertainty surrounding your future tax bill. The downside of making an 83B election is if the stock price drops or if you are not at the company long enough for the shares to vest. In that case, you would not only forfeit the shares but also the taxes you paid in advance for the unvested shares. It's also important to note that there are often rules restricting the sale of RSUs, where there are blackout dates during which time trading is prohibited. If you are considered an insider, you may need to establish a 10b5-1 plan to overcome blackout rules prohibiting sale of stock during certain times of the year. 10b5-1 plans let insiders pre-arrange future sales of stock. Because the sales are scheduled in advance, they are permitted to take place even on dates that fall within the blackout periods. For executives, stock options and RSUs are just two aspects of compensation planning. It all needs to be integrated with your retirement and estate planning goals in order to determine the best decisions for your situation.